Hello and welcome everyone to the Annuity Straight Talk podcast, episode number 104. Bryan Anderson coming to you from Western Montana, founder and creator of Talk.Com. Go ahead, like and subscribe or comment on any of your favorite podcast platforms or on YouTube. Share it with your friends, whatever you can do. I'm here with a popular guest. Everybody loves it when he's around. We got the guy from Orange County, California, the master of analysis, the man, the myth, the legend, John
Bryan,
Balmer. How you doing, buddy?
You again. Thanks for having me on. It's been a while.
Yeah, I was looking at it. I thought it was only like 6 or 7, 8 episodes ago, but I looked at it today and that was 20 episodes ago. So everybody's asking, what's he doing? What does he think? So what we're doing today is kind of like we're reading the market with John Balmer.
Man, it's been an interesting couple months, I'll tell you that. I mean, I just saw you. When did I see you? July. I didn't get to make it up to Montana this year, but hopefully we can still get it taken care of.
Not yet.
Not yet.
Not yet. Wouldn't need to tell everybody all the reasons I was down in California, but yes, I did get to meet John Balmer in person and spend time with his family. It was, wonderful people. It was a great time. Your wife is great and your kids are fun. So thank you for your hospitality as well.
Well, yeah, it's been a while as much as I do. It's been a pretty crazy year in the markets, to say the least, considering what we had last year. But, we could break it down. We've seen the market has been really bifurcated, and it's leaving a lot of investors' heads spinning. Why aren't they up as much as the market? Obviously, no client of ours has 100% of their assets in the market, so that makes a big difference. But, there's just been a huge bifurcation in the market. We can talk about a lot of different things. You let me know where you want to go and let's shoot at it.
Yeah, because John, like I would tell you, and you and I talk all the time, and we were talking before we hit the record button, and we do this a lot. You and I are both, from different sides of the table, trying to do the best for everybody that we can do, and we see things a little bit different way. That's why it's important to meet like-minded people who have a different perspective. But as far as index annuities go, now fixed annuities, guaranteed rate, and everybody loves those, but the index annuities, a lot of them fallen flat in the last couple of years, and everybody's kind of scratching their head. Wait a second, but is that the right thing, or did it work out the way it should? And some people second guess it. I've got advisors that come and say that. The last podcast was talking about how the indexes work in an annuity, and not that we need to drag you into that part of it, but again, what have we seen? An overall market in the last couple of years has kind of been flat with a few outliers as far as performance goes.
Yeah, I'd say so. I mean, the tech trade this year has been something that's really driven the markets, and we can dive into, construction of the different indexes or the commercially available indexes as much as we want, and we can touch on those. But, last year tech was down nearly 40%, and this year it's up nearly 40%. So, not necessarily at break even, but you're pretty close. And I would say that it's mostly driven by maybe top 10, top 15 market cap weighted stocks, particularly in the technology space, that have really driven returns this year. Because like I said, the bifurcation in the market has been pretty tremendous. You see a lot of different indexes or a lot of different sectors of the market down really, really significantly. It's sort of the tale of two markets, I would say.
Yeah. So what indicators should people look for? And again, we're talking about making sure people, number one is to keep the money you have, and number two is to grow it, I think. Don't lose what you've already got. That's where you come in line, and I hope people realize that John Balmer is a really good risk manager, and that's the number one goal, and then chase returns after you make sure that you're protected adequately. So what do you think are the key indicators for people to look at, John? You gave me a list of things that you want to talk about. What do you think is most important for people to look at right now?
Yeah, Bryan, I think the most important thing that we really need to focus in on is rates and where the Fed is going to take rates. It all goes back to Jackson Hole of 2022, where Fed Chair Powell talked about, controlling inflation at any cost, and realizing the very minute population of the country are investors in the market. So he really doesn't care about what the market does. In fact, he's probably pretty flabbergasted on why the market is just ripped higher this year, considering he continually tries to raise rates
Right.
and has. We've had the fastest growth of interest rates in what probably in history. It's the upward trajectory, and you've had a lot of different bank CEOs come out and say that rates could go higher. I don't know, but I think rates are something that you really want to focus in on because it impacts a lot of people, and it'll obviously help to slow down the economy and bring down inflation eventually. And I think the Fed's target of 2% is maybe a little bit ambitious, but if you can get inflation back down towards the 3% level, I think that could be palatable over a long period of time.
So what, like, if the Fed does hit the target of 2% rates, and that's going to mean some pretty disastrous stuff for most of the markets and most of the people's retirement portfolios, correct? They're not looking at, it's kind of an objective analysis where they're looking at, hey, what do we got to do to keep inflation in check? And whatever happens to portfolios or the stock market or anything else, like they're not focusing on that.
No, it's
right?
really, if they want to bring inflation down to that 2% target, 2.5, maybe call it 3. I think that they could do that. But the problem is that you've got a lot of different forces on inflation that are really, really driving it. Obviously, companies, when they raise their prices or reduce their packaging, mainly it's been price increases. If a restaurant goes in and their costs are going up, they raise their prices. If their costs go down, do you think they're going to lower their prices? By and large, no. Inflation is going to be sticky. And I think the Fed raising rates continually, and I think they'll probably raise again in September, maybe a quarter basis point. I'm sorry, 25 basis points, which is a quarter of a percent. And maybe they'll be done. And maybe, from a historical perspective, the markets will be able to digest that and the consumers will be able to digest that. But higher rates means higher borrowing costs, higher cost of capital, things in that nature. And that's not necessarily always a good thing for people.
Well, and it's interesting you say that. It's a really good analogy. Like a restaurant's going to raise prices to cover costs, but when costs go down, they're not going to lower prices. So then you're looking at like the time to catch up to it, relatively speaking, on inflation and whatnot. But everybody's got to be diligent on this whole thing and look at it and say, we're looking at a new reality, right?
Reality. And you got to think about it. Rates were going down since 1981. And there was a period of time between, let's just call it 2008 and 2018, like a 10-year period of time, where rates traded between 1.5% and 3%, kind of like this 10-year range. And then you run into right around 2018, where Fed Chair Powell tried to raise rates, and that crashed the market in December of 2018. And then he started lowering them, and you had this lowering of rates from right around 3% on the 10-year to kind of the COVID low of 0.5%. And since, let's call it the COVID low back in March of 2020, rates have gone up. So the 10-year has gone from probably 50 basis points or 0.5% to closed Friday at 4.1. That's a 695% increase in the 10-year over a 3-year period of time.
I think it's funny. Everybody sees that those rates like, oh, the Fed's raising rates and I'm just going to wait because I think rates will be higher. And you got to look at the number of times in the past 20 years when they have been higher than now. And you got to go back 20 years till they were higher than they are now. And what do you want to bet on, right? If you're doing financial planning and you're buying, even if you're buying bonds or annuities or something like that, you're hedging the market with the safe side of the portfolio. It's a pretty dang good time to lock it in because the Fed has an intention to take it lower. Do they not?
That I don't know, but you had for a very long time in my side of the world, they called it TINA. There is no alternative to stocks. With rates going up, you've seen what money markets do. Clients right now can sit and wait. Obviously, I don't think sitting in cash or money market is a great long-term investment strategy. You can get money market rates at 4.5% to 5% right now. Are they going to stay that way? If we go into a recession early next year, if at all, they're going to cut rates to try to save that recession. So money market rates, their short-term rates, they're going to go down. So if you can lock in some of your longer-term money in something like some of the stuff that you do, Bryan, where you can get in a long-term period, long-term guarantees, that's a great part of your portfolio strategy. But I certainly think rates could potentially go higher for longer. But eventually, if we go into a recessionary period, which we were expecting recession this year, now a lot of people on Wall Street, a lot of economists are expecting a recession early next year. Is it going to be a hard landing? If it's going to be a soft landing, what's the difference between the two? On one hand, we could have a soft landing. On the other hand, we could have
Right.
a hard landing. It's arbitrary, and a lot of people are mixed on
Yeah.
the street. You really don't know. No one has a crystal ball. If we did, you and I wouldn't be doing what we're doing.
Well, that's true. And from my perspective, it's like, okay, well, do you want to lock in the rate? You certainly can guarantee a rate that's not guaranteed in money market funds. I did a podcast earlier this year talking about where interest rates will go. It's as close to viral as any video I've done. A lot of people, like annuity rates in 2023, a lot of people saw it and looked at it. My prediction was, at best case, they're going to remain about stable, and at worst, kind of going along with a lot of things that I'd heard. I thought they were going to drop, but they haven't. They've stayed stable. I mean, they're probably about where they were about a year ago, is what it is. Up and down, bouncing around. I don't know. I guess that's not even asking for specifically a comment on that, but just my observation that kind of thought they'd be lower as well. And you said the same thing, right?
Rates have tried to keeping their head above 4%. I don't know. There was a quote from J.P. Morgan, which is the largest bank in the world, largest bank at least in the United States. Their CEO Jamie Dimon, who's has been a banker for many years, been the helm of that bank for many years, talked on their last earnings call about Fed funds rate going. He advised people to be prepared for 6, maybe even 7, which wouldn't necessarily be good.
John, why don't you tell everybody what you think is important to look out for and things they can pay attention to in order to rationalize what's going on in the market or to make moves going forward? Does that sound all right?
I think, Bryan, as we talked about being in a bifurcated market, and I'll just use some examples right now. The S&P 500 year to date is up about 17%, maybe above 17.5%. By and large, that's been driven by the top 15 or 20 stocks. And if I look at the S&P 500, it's 500 stocks. And the top 15% or the top 15 companies represent 36% of that index. The top 20 represent 41% of the index. And the top 50 companies represent 56% of the index. I mean, you're talking 500 stocks, yet the top 50 represent more than half of the index. That's why you've gotten such a strong rate of return year to date. But, it all depends on what sector you're in as well. By and large, it's a market cap weighted index, which means the larger your company is, like Apple, Microsoft, Amazon, the bigger weighting they have on returns. And those who, in particular, are companies that have done fairly well this year. So the overall market's up about 17.5. Communication services, which top holdings are Google, Netflix, and Meta, otherwise known as Facebook, is up 40% for the year. Consumer discretionary, which is Tesla, which you couldn't get anyone to buy last year because it was down 80%. Now, Tesla is up 100% this year. The cruise lines are up 100% this year. Amazon is up 60% this year. That sector is up 31%. Consumer staples, we're talking about Budweiser and Walmart and Constellation Brands and Costco, big companies like that. That sector is actually down on the year, down 3.5%. Energy was up 60% last year. Flatlined, it's only up 3.7%. Financials, banks, we obviously had some of the largest banking crisis that we've had in March. We had some very large bank failures, Silicon Valley Bank, amongst others. And then you've had some acquisitions along the way. That was the largest banking crisis we've had since the great financial crisis. Banks are, up 1.5% on a year. Healthcare, very defensive. Healthcare is down 2% on the year. Industrials, companies like General Electric, Old Dominion, FedEx, you name it. That sector's up 10% on the year. So if you're really kind of making sector bets, or it really all depends. A lot of people say, well, top technology companies are up 30, 40, 100%. But yeah, if you have a well diversified portfolio, you're capturing some of that. If you're an all equity investor, you look at real estate. It is flat on the year. It's actually up 0.19% year to date. You've got all the home builders. You've got pressure on home buying with higher interest rates. You've got perhaps or potentially a commercial real estate crisis coming down the pipe. All those empty office buildings. In fact, it's interesting. Commercial real estate is very cyclical. It's been hurt considerably since the pandemic. One thing I'm seeing though is, the hottest sector in real estate over the last several years was, industrial warehouse space. It's interesting. Some of those have been performing. The new stuff that's coming online, and I'll just use for an example. There was a 300,000 square foot, which is a large facility, Amazon warehouse built 2 blocks from my office. It's been done for 6 months and it's still sitting empty. So, what is Amazon's pulse on the economy that they're not putting people to work there? Are they seeing a decline in shipping or packaging? And that kind of leads into retail. Retail is, when we talk about a bifurcated market, you've got technology up 40%. You've got retail really taking it on the chin. And I'll just use a couple different companies for example. Credit card delinquencies are on the rise.
Yeah, so
People
people
are
aren't paying
starting
bill,
to
right?
not pay their credit card bills. And that typically tends to be on the lower end consumer. But you're looking at, very large companies. Macy's is just reported negative 10% year over year growth. 80% of Nordstrom earnings come from their own card, and their earnings were down 15% year over year. Dick's Sporting Goods down 19% on their last earnings call. They missed every metric. They cut their guidance by 15%. And the management blamed a lot of those things on shrinkage, which is a nicer word for theft. So you see a lot of these.
Theft, yeah. No, I remember, yeah, my minor stint at Home Depot where there was a
Sure.
shrink officer and the guy was out looking for
Yeah,
people
absolutely.
shoplifting.
And I don't know if you ever see any of these videos online, particularly here in California, where it's almost legal to steal anything under $1,000. You have these organized rings of theft, and they walk into a mall and they'll steal anything that's not bolted down to the ground.
Are
Those
those
videos are
videos real?
absolutely real. In fact, I know some people who are theft prevention officers at some of the big malls here in Newport Beach and South Coast Plaza. They are very real, and those people, it's a liability to get in the way. So a lot of, I mean, look at San Francisco. They've lost, almost 60% of their large big box retailers. Nordstrom just closed. They're planning on closing the largest mall up there. I believe Apple is considering pulling out. Nike has pulled out. A lot of these big flagship stores in the Union Square area are just subject to Old Navy. Old Navy, which is one of the Gap stores, largest brands, they've pulled out of San Francisco. They closed that store. Whole Foods has closed a store in downtown San Francisco due to theft. CVS, Walgreens. You go into a Walgreens in San Francisco or in LA, everything's behind glass now. Freezers and everything are chained shut. You have to get, it's crazy. So yeah, it is very real. Dollar Tree's down 30% since November. Dollar General, which are lower end stores, down 50% since last year or since the beginning of the year. Burlington, a direct quote from their CEO, and said it's clear the low income shopper, which is their core customer, is still under significant economic pressure. Why? Inflation. Wages aren't going up as fast. Gas, here in California, I pay $5.75 for a gallon of gas. It's just crazy. Oil is above $85 a barrel for the first time in a year. Things are going to start to continue to rise. I think we're going to have a spike in inflation. Kohl's, their quarterly comps are down 5%. The stock's down 60% in a year. Foot Locker, stock was down 25%. Comps are down 9.4%. They're cut full year guidance. The only bright spots in retail are Ross stores and TJ Maxx, which is secondary inventory. Retail and the consumer are really, really getting hurt. People are buying less. They're late on their credit cards. They're not paying their credit cards. So, at some point, something's going to have to give. For a company to go out and borrow money, they've got to pay high rates. Cost of capital has gone up significantly. So there was a theme in the last earnings cycle that a lot of companies were, if they saw an increase in their capital expenditures, which we did see with Microsoft, despite the great year with all the AI buzz. Microsoft is down from its all-time high after earnings. Apple is down from its all-time high after earnings. Amazon, a lot of these companies that could not control costs or had to spend more. That was the big theme during earnings. If you were not controlling your costs or doing anything to mitigate those capital expenditures, your stock has really taken a hit, despite some of the big gains. So I think we're in a really bifurcated market. Things could go either direction in the next, let's say, 6 to 12 months. And I just advise investors to be patient. We're not investing, 1 to 6 months. We're investing for many years. And so when you think about it, if you can lock in a certain part of your portfolio, whether that be in short-term treasuries or in certain annuities that Bryan, that you recommend, those are all great parts of a portfolio that can help diversify and really manage risk appropriately. And then you can sit back and wait and pick your certain spots. Just because a company has gone up 100% in the year doesn't mean it won't go back down. Just Nvidia was down 80% last year. Tesla was 85%, 75%. Microsoft was down significantly. Facebook or Meta was down 80, 90% last year. I couldn't sell them to people. They were on so cheap. And now that Nvidia's back up to $500, people are now interested in it. I just don't understand. Should have been buying it when it was $115 last August. But
Yeah, logic is a rare commodity, is it not?
It is. We could go on. Where does the market go? We don't know. We
Well,
don't know. It's tough times in a lot of things. There's still a lot of issues that we need to sort out. I just encourage people to be really patient with their advisor, with their portfolio. Know that if you work with Bryan or I, we have your best interest at heart for the long term. And we're not always going to hit the bottom. We're not always going to hit the top. But I truly believe that we will eventually work our way out of this tough market, and there will be smoother seas ahead.
we do have everybody's best interest at heart, and that's why I started having you on this podcast from the beginning, John, because I recognized what you were able to do, and we're average people, right? You and I both. And we like to relax and enjoy our families and do the things that we like to do and not worry about money and finances and all that stuff. And when we're in a business to help people with finances and money, a lot of the recommendations we have are things that we live by because we have those values for ourselves and we have those expectations for ourselves. I appreciate you saying that. But again, we're not going to do anything for you guys that we can't, that's going to cause us to not sleep at night, right?
Yeah, absolutely. Being in this business is one of expectations. And like I said, we're not always going to hit it out of the park with your entire portfolio. We're true believers in diversification, whether that be having your sleep at night, safe money, and then having a well-positioned portfolio in and out of the equities or the fixed income markets. I certainly think that you have to take a very long-term perspective on the markets and know that not everything is tech. It's always what I try to preach to clients. There's so many different variables that go into a construction of a portfolio, the management of markets. There's so many things that affect the markets, whether it be rates, the dollar index, unemployment, jobs reports, things like that we have no control over. Different policy. We know that over the long period of time, that if you have exposure to different asset classes, you will do relatively well.
It's very important. Be patient. You're talking about retirement when people need to be out there worrying more about how they enjoy their life after all the hard work. Too many people get caught up in, hey, I got to beat this or that, or these guys say they beat the market. They do this and that. It just doesn't make sense. Like, enjoy your life and forget about
Bryan,
it.
and I don't
relax.
want to interrupt you. That's one thing that you and I have talked about before. You've got a lot of managers out there who always claim to beat the market. I beat the market. I beat the S&P in the risk world. And what I try to do is manage risk as much as possible. And a lot of clients that have come on board over the last year, we've done what's called dollar cost averaging into the market, because I don't know what day the market's going to be up or what the trends are going to be for the short term. One day, 1 week, 1 month doesn't make a trend in the market. The overall trend is up and to the right. We try to put money to work in a sensible manner. But that kind of goes back to, a lot of advisors out there. If you work with an advisor, really ask them if they claim to beat the market every year. Are they actually beating the market? Are they actually positive every year? Or are they actually just benchmarking to a benchmark? And I'll give an example. There was a client last year who worked with another advisor, and they said, we beat the market. And I said, well, the S&P 500 last year was down 20%. Their portfolio was down 17%. So yeah, they actually beat the market, but they were still down 17% from where they started. You have to actually define what constitutes beating the market. Are you beating the benchmark? You're still down. When they're getting into new relationships or looking at different advisors to ask those questions, what's their risk management philosophy? A lot of people that I meet, being in the world that I'm in, they always say, I want to work with a CFP. And I said, that's great. Maybe you should, but CFPs lose people money too. So it's just, you got to set the right expectations in this business. I always say to people, I'm not the greatest fit for everybody, but if you hire Bryan and I, we're gonna take your best interest at heart. We're gonna work our butts off for you, and we're gonna make sure that you can sleep at night. Bryan and I don't really sleep a whole lot, so you sleep more than I do. So
we'll knock it out of the park for you, and we'll be real about it. So that's what we do. 2 words: we win. That's what we do. I'm good. You're good, John, regardless of what's going on in the markets right now. Grateful to have your perspective on this. Thank you so much for being here. Sorry about my video for the last, 15, 20 minutes. I'm an idiot. I can't manage to charge my camera the right way. But we're good, and you wanted to hear what John had to say mostly, so that's what everybody asked for. You're the popular guy. Anyway, so it's like, hey, when's John going to be back? Can we get John back? Like, yeah, I'll let him know. Yeah, see what he does. Just a note, again, you're not allowed to contact or search for John. He's easy to get a hold of if you ask me first. He's not here to advertise. He's here as a service to the people that subscribe to this podcast and to my newsletter. He runs into a whole bunch of garbage if he's out advertising online, and that is not what he's doing. I don't want to waste his time. A lot of people that call me, I love everybody and great, go and ask me questions. I put myself out there for that, but I do not put John out for taking random calls from random people. So if you want to talk to him, you get a hold of me. Please go ahead and the podcast, YouTube, or your podcast platforms, comment, share it with your friends, and let everybody else know, because we got good information. We're a couple of good guys out here to help you navigate the markets and figure out what is best for you. It's pretty simple, and we're certainly not looking out for ourselves for, hey, John, thank you for joining me on this episode. We'll have you back as soon as possible, okay? And everybody have a great week, and we'll talk to you next week for episode 105, I guess. Okay, have a great day. Bye.